Hello, everyone, and welcome to our show today. So today we're going to be diving in and talking about 15 reasons that having business credit's a must for every successful company. And we're going to talk about a lot of things you might not know about how not having business credit can hurt you. So this is going to be kind of an overview of what you really should know about business credit, what it will do for you, and what it's also probably preventing or causing problems with you now that you may not even know about. So for those of you that don't know me, my name is Ty Crandall. I'm actually the CEO at Credit Suite, and this is what we do at Credit Suites. We help companies build business credit. We've helped over 15,000 companies do so today. So I have a lot of knowledge and experience about what business credit can help you and what not having it can hurt you. And that's exactly what we're going to be diving into today. If you'd like a free guide on building business credit, feel free to go to our website, creditsuite.com/EIN, to get that free 4-step guide. That's at creditsuite.com/EIN. So when we're talking about business credit, of course, we're talking about business credit credit that's linked to a business's EIN. It's in a business's name. Okay. So when we talk about this today, we're specifically referencing credit for a business, not credit for you as an individual, or not credit for you as an individual that you're trying to use for a business. This is credit that's not linked to you personally. It's not linked to your Social Security. It's not linked to your consumer credit report. It's not credit that's seen by anybody that's looking, or your personal credit's not seen by these lenders that are making these lending decisions. It's the business credit that they're actually seeing. So they're making the quality of decisions of approving you, the rates and terms you'll pay, et cetera, from this quality of your business credit. It's also not linked to your personal social if you've done this correctly. Now, as of 2018, some sources may ask you for a date of birth and a social only for identification purposes, but they're not pulling your personal credit when you build business credit the right way. So your approval decision isn't based on your personal credit quality. So using business credit, a business owner can get a lot of different kinds of credit. You can get vendor credit cards. This is what we call the vendor credit tier. This is the initial credit or initial tier of credit that you get that then reports to the business credit reporting agencies to help you establish your initial credit profile and score. You get high limit accounts with most major retailers: Sam's Club, Costco, BP, Chevron, Sunoco, Best Buy, Walmart. Almost every major retailer, even Amazon, gives you corporate credit cards. These business credit cards are not required to provide a personal guarantee or a credit check for approval. And then you can move on to fleet credit as well. This is for fuel. It's for auto vehicle repairs and maintenance, the fleet credit tier of accounts. Then you move to the cash credit tier. And this is Visa cards and MasterCards and American Express cards. So when we talk about building business credit, this is what business credit is. And it's important to notice that because a lot of lenders are referencing things as business credit, which really have to do with equipment financing and account receivable financing. True commercial credit, true business credit is this type of credit. It's credit that you're getting that's linked to your EIN, not your social. It's credit that you're typically building through a series of steps, including vendor credit, retail credit, fleet credit, and getting to the end goal of Visa card, MasterCard, American Express. It's all credit that you can get regardless of cash flow, personal credit quality, collateral. So these high limit accounts is what you're able to get as the end result of building this business credit. Now, you can get approved for business credit accounts regardless of personal credit quality. Okay, so when you build your business credit the right way, you're not supplying a Social Security number to pull your personal credit. Again, if the credit card you're getting is backed by major banks are now required to get your date of birth and Social Security number, but only for verification purposes. And it's usually quite clear that that's the case. So for example, I just got a WEX fleet card for the business last week. And when I went to apply, it clearly told me after I filled out the application, the next page, we need your date of birth. We need your Social Security number. It's only for verification purposes. They clearly outlined that it wasn't being used in the credit decision. So again, getting these approvals regardless of your personal credit quality is very important. So again, if you're not giving them the Social Security number, you're not giving them the permission to pull your personal credit, then what happens is there's no personal credit pull. So you're getting approved for business credit regardless of your consumer credit quality. Now, because of this, you can get high limit business credit accounts regardless of personal credit quality, no matter how good or bad it may be. So personal credit quality does not matter. Now, I'm not telling you to ignore it. As a business owner, you're going to need to focus on your personal credit. There's a lot of loans. There's a lot of credit lines. There's a lot of things where having good credit is definitely going to help you. But what I am telling you is that personal credit quality is not a deterrent to get business credit. I don't care if you've got an 850 credit score or a 350 consumer credit score, you're still going to be able to build business credit just as fast and get just as much, no matter which of those you actually are. Okay, so business credit reports to the business credit reporting agencies, not the consumer. So that's really really one of the many reasons we're going to talk about today that you want to build business credit. Because as business credit is used, it has no adverse impact on you, the owner's consumer score. That's because it's not reported to the consumer reporting agencies. So that means utilization that accounts for over 30% of your credit score won't have any adverse impact on personal credit. Here's what happens. I see this happen all the time. Business owners think about an idea. They go to get in business. They know they need money. They think about where they can get money. And they typically, in a lot of cases, rely on their personal credit cards. And all the statistics support this. Why? Because they have credit available on those credit cards. Typically, the expenses to get the business started are more than they anticipate. They max out those credit cards. Then they go looking for money. Well, the problem with this is that utilization, this aspect of your consumer score, is 30% of your overall FICO score. So if you're overutilizing those accounts, meaning you're putting higher balances on those accounts, then that can dramatically lower your score and ruin your ability to get access to the money you need. So it's very important that you get credit that only reports to the business credit reporting agencies, because when you do so, you can max that credit out and not have any adverse effect on your consumer credit scores. So, and there's no inquiries on the personal credit when you're doing it this way either. When you're building business credit, you're getting credit without inquiries on your consumer credit report. And that's very important because we have funding that you could be cost $25,000, $50,000 less in money that you could get because of 1 or 2 inquiries on your credit report. In the business lending world, inquiries are very important. And when you start getting inquiries from Bank of America and Chase and all these major underwriters of commercial credit cards, the problem is that lenders don't know if you're getting a credit card or a loan. So they oftentimes deny it just because you have inquiries and just because the inquiries are coming from major lending institutions. They don't know if you were per se issued money, and maybe it's not yet reporting on your credit reports. Okay, so it becomes very important. Keeping inquiries off your personal credit reports for business accounts, making sure that the accounts that you're getting to use for the business don't report to consumer credit become extremely important for you to be able to have success with building business credit. So 10% of total consumer scores based on inquiries. So again, if you use your personal credit, then you're going to have a lot of inquiries that not only lowers your scores, but it's the inquiries itself that ruins your ability to get money. Okay, so this can really stay on there for an extended period of time, can cause you great harm, can cost you money, as we talked about, and some unsecured lending, as I mentioned, can even deny you for financing because you've got 2 inquiries or more. Look, here's the problem. Consumer credit was never designed to fund a business. The limits you get on consumer credit cards are much lower than you get in the business world because they're not intending, these credit issuers, that you're using personal credit to actually fund a business. That's the whole problem to begin with. So when you're using the credit for a purpose it's not intended, you could really, really, really damage your scores as a result. So you also want to save that personal credit utilization, as we talked about, okay? Because using personal credit cards to pay business expenses really is going to harm that utilization rate. Now, utilization is the amount of credit used divided by the total available credit. You want to keep your percentage at 30% or less, but that's kind of a myth as well. The reality is that any balances that you have on any kind of credit will adversely affect your scores. Really, you want to keep a balance less than 2% on your credit cards. But it's estimated that over 30% is where you reach a threshold where you start damaging your scores versus helping them. Meaning the fact that you have a credit card that you're paying as agreed, the fact that you owe 30% more, or 30% of the balance on that, or the limit on that card, actually hurts your score more than the benefit of having an account that you're paying as agreed. So it really, really, really can lower your scores. And since 30% of your scores is based on this, then it's a really big deal when you're trying to pay business expenses with personal credit. It just makes it nearly impossible to keep your score intact. Okay, so using your personal credit to fund the business really lowers the scores. And again, the problem with that is that in doing so, you're really, really, really hurting your ability to get other kinds of money. Okay, and that's what it really comes down to. You really want to make sure that you're building business credit, so then that way there are no inquiries when you're getting these credit cards. Guys, here's how important inquiries are. I don't have personal credit cards. I don't. My wife has them all. And I realized that the other day when I went to apply for one and got a really low limit. I'm like, what is wrong here? We usually get really high limit accounts. Here's why. I save all my inquiries for the business. Okay, when we need a merchant account, when we need a loan, those type of things, there's going to be inquiries there. So I know the value of a business owner of inquiries so much to the point where I don't even let people pull my personal credit for anything personal, except for if it's an auto loan, a mortgage, or something to that effect. The same with utilization. We never put business expenses on personal credit cards, because the minute you do that, you dramatically lower your score, and your ability to get the loans and credit lines and funding you really want is greatly inhibited as a result. So remember, there's 5 aspects to consumer credit scores: 35% of your score's payment history, 30% utilization, and so on. So 30% of that score is based on what available credit you're using, while 35% is payment history. The reason I'm showing you this is because that means that by overutilizing revolving accounts, you literally damage your scores almost as much as if you just paid those accounts late. So another good reason you want to build business credit is good business credit scores can be built very quickly. So business credit scores are mainly based only on if a business pays on time. And that's primarily exactly how they're based. The only real exception is Experian's IntelliScore, which is 85% based on payment history. The other scores are 100% based on payment history. So the D&B PAYDEX score, for example, is the most widely used score in the business world, and it's solely based on business history. Equifax's small business risk score is also solely based on history. And again, 65 to 85% of Experian's IntelliScore is also based on payment history as well. So if we look at D&B's PAYDEX score, it's much different than what we looked at with FICO. With FICO, we found 5 factors. One affects 35, 30, 15, 10, and 10% of the score. But the PAYDEX score is 100% based on payment history. So if you pay on average 21 days late, you get a 60 score. If you pay promptly or on time, you get an 80. If you pay early, you could get a 90 or 100. The score literally depicts how you pay your bills. It's the only factor that the score is based on. So consumer credit scores, again, are made up of those 5 factors. And the result, it takes many years of well-disciplined borrowing to get good scores. But business credit scores are built really quick because all that's needed to have accounts report is good payment history. So if you watch me on Facebook Live, I go live every Wednesday at 4 o'clock. You'll see that we pull up real commercial credit reports and we look at them. And I always use the same example. Here's reports with people with no scores, no credit established, and they have low scores, 28, 29 scores with no credit established. And we'll talk about that a little bit later, how you can get a failing score even if you don't have failing credit. But then I show the example of somebody that got one account, and one account took them from failing to excellent score. You can even see on the report how they went from a 28 to a 96 score. How's it possible? It's possible because your scores are only based on payment history. So all it takes to raise your score is good payments. If you mess up and you pay an account bad, well, then have more accounts that you pay good and pay them earlier on time, and that offsets the score. So the whole key here is just to get accounts that you're paying on as agreed. Okay, if you're doing that one thing, you can get good scores. This is why it can be built so fast. Because you can come in and start with no business credit, get some vendor accounts. They start reporting in 30 days. Once they hit and you have good payment history, you immediately get a good score. Then you use that established profile, those good accounts, that good history to then start getting the credit that you really want. It's very easy and very fast to do because, again, what it comes down to is getting an initial score. You can't do that in the consumer world. In the consumer world, it takes 6 months of you having credit before FICO will even give you a score. In our world, on the commercial side, in 6 months, you can get to the end. You can get the Visa card. You can get the MasterCard. You can get the Amex card with no PG, no credit check, all the way to the end. At the same time, you could even get an initial score in the consumer world. Very fast, very easy to do. It's just a matter of getting accounts at report and paying those accounts as agreed. Okay, so anybody can see your business credit reports. Now, with consumer credit, somebody has to have your permission to pull your business credit reports. It's a law. It's under the Fair Credit Reporting Act, and it's called permissible purpose. Somebody has to have your permissible purpose. They have to have your permission to pull your credit reports, and it costs about $1,000 or so to do so. If someone pulls personal credit without permission, they can pay $1,000 or more in fine, depending on the state that they're actually in. Now, with consumer credit, only certain organizations really can even pull your business credit report or your personal credit reports. Banks, auto dealers, mortgage brokers. I mean, It's typically people dealing with the issuing of credit or loans. Now, with business credit, it's very, very different because with business credit, this information is public. This means anybody who wants to see your business credit reports can easily and cheaply do so. Now, there's several things to note here. First of all I need to pull your business credit report is your business name and the state that you operate. That's it. It's all I need. And sometimes I don't even need your state if there's only one company across the entire United States that has the same name. Remember, anybody in any state can have that name one time. So if I have your business name, if you have a business name, ABC Company, if I go to Florida and ABC Company is not being used, I can use that same company name. So the only thing I need to know is which company is yours. If you have a unique name, well, then I can pull your business credit reports by only your name. If there's several companies with similar names, well, then I'm going to look at the state that you're in the name to figure out which company is yours to pull your report. With as little information as that, I can pull your business credit. This actually freaks some people out when they're getting vendor accounts because they don't even supply an EIN. We don't need your EIN to pull your business credit. So not only can anybody see this, but if you go to Dun & Bradstreet Equifax Experience Reports, one of the first things they do is give you a choice. Do you want to look at your company or somebody else's company? You have to keep in mind that this information is public. I show Pixar's credit report all the time when I'm doing demos of our system because it's public information. When the election took place, we reviewed, if you go back to our live videos on YouTube, we reviewed Donald Trump and Hillary Clinton's organization's credit reports, both because it's public information. So again, anybody can see your report, suppliers, customers, clients, investors, lenders, credit issuers. But the difference is that they don't typically tell you they're pulling their reports because they don't need to. The Fair Credit Reporting Act says if they pull your consumer credit report and they deny you, they have to tell you that they pulled it and which bureau they pulled. There's no such regulation in the business world. So lenders and credit issuers are pulling your reports and making denial decisions all the time, and you don't even know why. Not to mention that prospects, clients, competitors, everybody can see it, which is one reason you really want to focus on growing it. I had a podcast. I was a guest on a podcast, and her and I were talking about this, and I pulled her credit report when I was right there on the call, freaked her out. And when we got off the call, I said, yeah, anybody can see this. See how easy it was for me? And she said, well, I have a competitor, so-and-so. Can you pull theirs? I said, sure, I pulled it. And we were sitting there reviewing what their credit report said. They were late like 3 quarters before. We talked about, man, they really went late here. What happened? She knew what happened to cause them to go late. So it was really a surreal experience for her to realize that somebody could abruptly pull her report on a whim and even pull her competitor. And then the information she was able to gain from that competitor's credit report. So again, this is widely used information and people are pulling your reports. You need to know why. You need to know how it impacts you. Now, that being said, inquiries don't really matter. Inquiries will show on on business credit reports. They'll show the number of inquiries you had, not the company. But that doesn't affect your score. So we don't care about these people inquiring, which is another reason anybody can pull the report because it doesn't affect your score. But it does happen. It does show the number of inquiries on your credit report, your business report, even though it doesn't matter calculating the score. So business credit reports are public, as we talked about. Anybody can see that information, prospects, customers, suppliers, competitors. They can see the amount of trade lines you have, past payment performance, credit scores, high credit limits, employees. They can see your revenue. All this information is publicly available to anybody that wants it. So my advice is to pull your own business credit report. You can go to creditsuite.com/monitoring. Get $24, Experian and DMB if you have business credit established through our NAV integration. And what that will help you do is it will help you see what others see about you. It doesn't make you look reputable. If you're an outside prospect, client, supplier, lender, and you're looking at the same report, would you think the business you're looking at is credible? It's a good exercise to go through with reviewing your own report and score. Okay, so again, as we talked about, all that's needed is your business name and the location, and they're able to pull that. So another benefit of business credit, there's no personal liability and guarantee when an SSN goes on an application. Now, well, I'm going to clarify this because this has recently changed. It almost always means the applicant's providing a personal guarantee. This was always my safeguard to tell people everywhere in the past that, look, if you're supplying a social, you're probably supplying a PG. Here's what happened. In 2016, the government did what they should have done many years ago, and most other countries have done. They put in place laws to help prevent money laundering. And one of the black holes that they found was that people with businesses were able to apply for bank accounts and all these other things without needing to supply and really provide their identification. Well, obviously, that's problematic because launderers can come in and form businesses and use those entities as ways to launder the money. So the government came back in 2016 and said, listen, we have a new regulation. We now require all major banks to supply with every applicant for verification purposes a date of birth and a social security number. So this has changed over the last 4 months as people been adopting to this because it rolled out in May of 2018. So now you can't just use whether you're supplying a social or not as the deterrent to know if you're providing a personal guarantee or not. First, never provide a social if you can get around it. Vendor credit, you don't need it. A lot of credit that's not issued by major banks, you don't need it. But when you get into Staples and Office Depot, that's underwritten by Citi. Citi's a major bank. Citi has to provide the information for verification purposes. So if there's not something that clearly tells you that you're only supplying it for verification purposes, do not fill it out. Either fax the application to leave it blank or call in the application and let them know they don't have your authority to pull your personal credit. You're not providing a personal guarantee, but you're okay to provide it for verification purposes only, and you'll be okay. So that's kind of the new safeguard you have to build in is you may now have to supply a social if the card's being supplied by a major bank, but then you want to make sure you're not providing that PG. You're not providing and authorizing a personal credit check. So this means they are personally liable for the business debts. If you are the personal guarantee, that's what that means. If you were to default on one of the obligations, the creditor will pursue your business assets first. Look, this is a hard conversation to have with you, and here's why. Because what really happens is, first of all, you don't intend on failing. I know. I stand in front of large rooms and ask, how many think you will fail in the next 12 months? And nobody raises their hand. But statistically, 1 out of 3 people in that room will fail. I was one of them. I had a mortgage company, height of the mortgage industry, no chance on failing. We were doing great. We had tons of reserves. We were making tons of money. And then all of a sudden the economy shifted, and literally overnight, we completely lost our ability to be able to lend money. So overnight, something that was completely out of our control completely took my business down. What happened was I personally guaranteed the business debts. So when we started to default, they took all the money out of my personal accounts, money that we didn't even have, the last money we had left to live off of. Okay, that's how it went down. And since I personally guaranteed everything, they came after those personal assets. They started reporting stuff on my personal credit report. The minute that started to report, all my consumer credit card issuers lowered my limits to what I owed. My consumer credit scores tanked. The whole thing spiraled down because I PG'd my credit. I learned a very hard lesson, and it's why I'm here today teaching everybody else how to avoid the same mistake that I made. Okay, so the creditor will come after your personal assets, including home, car, stocks, bonds, bank accounts, any other assets. In my case, they waited till we had the much money as we typically would have in our bank account, the highest amount, and then they pulled it all out. They immediately just withdrew it and pulled it out of the account. The problem was that we had checks written against all that money. So not only did they take all the money that was there, they took money we didn't really have, because then all those checks bounced and it became a complete nightmare of a process. So again, they will take all of your home assets. Here's how it works. They look at wherever the most assets are. If you have assets as an individual, they come after you. They come after the business assets as well. So again, I've had a collection agent approach me after a seminar crying and saying, I feel really bad because this is exactly what we were trained to do. Go after business assets, come after all personal assets after. So you have to protect those assets, and that comes from not providing that personal guarantee. So business credit protects those assets if all else fails, okay? Because again, most businesses do fail, and a large part, it's because of things out of their control. And a large part of the reasons business fails is because of management issues, and a large part of them have nothing to do with management issues. As a matter of fact, the 2 biggest reasons that businesses fail, number 1 reason that business fails is that there's lack of access to capital. And the second reason that business fail is because of the management mistakes made by the business managers. So what ultimately happens is that things go wrong in the business. The manager or the business owner doesn't have the money to carry them through, and then they end up going out of business. Statistically, this is why businesses fail. Okay, unexpected things happen. They don't have the money, and they end up shutting their doors as a result. So, and a lot of times it might not have anything to do with you. Like in my case, it was the economy. And other things that may come from you that just having access to that money can help you. But without a doubt, starting or running a business is risky. This is why most conventional banks make it so hard to get a loan. So don't use a personal guarantee unless you absolutely have to. Don't get me wrong. You're going to have to with loans. If you're not really well established with loans and credit lines, you're going to have to. Here's why. Your revenue, your employees, profits, that kind of stuff shows on your business credit reports. So when you start to get into loans and credit lines, they want more documentation. They're looking at different scores. They're looking at more information. They need more information from you. Yes, business credit's a major factor to getting approved for loans and credit lines, but it's not the only factor, as with any kind of loan and credit line. So you can get away with not using personal guarantees on every kind of credit card. So whether it be a credit card you use in a store, a Visa card, an American Express card, any kind of revolving credit, excluding credit lines, you can get without the guarantee. And as your business becomes really well established, you can even start to get around the loans and credit lines in due time as well. But again, with business credit, it's not necessary. You can oftentimes get around it completely. So business credit also helps increase the value of your business. Look, if there's two businesses that have been open for 5 years and are the same in every way, except company A has no business credit profile score and is being recommended for no credit, and company B has 10 trade lines, an excellent business credit profile, $52,000 in available credit to help with the new business owner and growth, and is being recommended for $42,000 in credit from the business reporting agencies, well, which would you choose, right? So if you could go into a business that already had established revolving credit, established credit lines that you could use to fund the business, don't you think that business would immediately become more valuable than the one that doesn't? It absolutely will be. So having this really increases the value of your business. And anybody that has bought or sold the business knows this. Knowing how easy credit reports are to obtain, if you were a buyer, wouldn't you get it? I mean, if you're ever going to sell your business, bring in an investor, if you were going to invest in a business or buy a business, wouldn't you pull the company's business credit report? It's easily accessible information. Of course you would. And would you want to buy the company from what you said on the report? Again, that's a good thought exercise that I mentioned earlier. Pull your own report. Would you want to buy your company? What does your report say about your business? Okay. So if you don't want to buy, or if you wouldn't buy your company from the report, you need to probably work on building the report. Is the company established? Okay, do they pay their bills? Do they look like a successful company? These are the kind of things that people looking at your business credit reports are going to do. So you need to make sure you build your business credit, because whatever you're going to do, it's going to help. Whether a family member takes over, an employee takes over the business, an outside investor comes in and invests, somebody buys the business, you go public. In any case, in any of those scenarios, it's going to be a very big deal that you have business credit established. So business credit quality also determines the loan approval terms. It actually determines many different things when it comes to you actually being able to get approved for financing. Remember, there's no Fair Credit Reporting Act in the business world. So I talked about there's no requirement that lenders and credit issuers will tell you. Now, I'll admit there are some better lenders in this than others, like Regions. Regions Bank clearly tells you that you're getting denied based on business credit. On Deck, they're a big revenue lender. They clearly issue denials telling you that you're denied based on business credit quality. But a lot of lenders and credit issuers don't do this. They may deny you and you may never know why, because they're not required by law to even tell you that they pulled your business credit report. They don't have to let you in that it was used for a lending decision. So even though you don't know it was reviewed, it is being reviewed. And even high-risk merchant cash advances like On Deck are really looking at and basing approvals partially based on business credit quality. And you can't even think about getting an SBA loan without building your business credit. It literally is impossible, because you'll never have a high enough score to qualify for an SBA loan if you didn't go through and establish your business credit. So it's very important. Now, business credit determines three things here. It really is going to determine if you're going to get approved, one, or denied, the approval amount. Experian, Equifax, and DMB all have a recommendation of credit on your credit report. It shows clear as day how much credit you're recommended for. If you have time tonight, we're doing a live webinar at 5 o'clock Eastern on 7 vendors you could use to build business credit. We'll be diving more into that during that. And it also, and we'll show reports and show those credit limit recommendations. So it determines how much you'll be issued, because they say how much you should be issued in credit or lent. And then the other factor is that will also determine the rates and terms that you'll pay. So if you want to make sure that you come in and that you have the best chance of getting approved for financing, then this is something that you want to make sure that you do, because it's going to determine if you get approved the rates and terms that you may pay. So business credit doubles your borrowing ability because it's the only way you can legally create two credit reports and score, two credit profiles. You have consumer credit, okay, then you have a whole new credit profile for your business. So having business credit is really the only legal way to have two credit profiles, because you can't go into Staples and get a consumer credit card and then walk in tomorrow and get another one, okay? But you can walk into Staples and get a consumer credit card and walk in tomorrow and get a business card, okay? So you can do that with business credit, but you couldn't do that with consumer credit. So it's the only way you really more than double your borrowing ability, because every credit issuer that you have credit with now, you can get that approval and then some with business credit because you have two reports, business and consumer. So with access to more store and cash credit from those sources, you also have access to a lot more usable money, bottom line. So you really more than double, because the approval limits are so high on business credit, but you could pretty much double every card you have in your wallet because you can have a consumer and a business credit card equivalent. So business credit also, as I mentioned, has very high limits, okay? Per SBA, the limits are about 10 to 100 times higher with business credit than consumer credit. So not only can you get it fast, it's also credit with very high limits that more than doubles your overall borrowing ability. So the reason for this is we talked about businesses have a greater need for credit than a consumer does. It's called credit capacity, okay? A business, you may never as an individual need to spend 10 grand at Dell on home computers, but a business easily needs to spend 10 grand on computers at Dell to fill an office. This is why businesses have greater capacity than a consumer. And you can easily need this much money for a business when you don't as a consumer. So getting business credit radically increases that amount of available credit. If you're used to getting a $3,000 Staples credit card, you'll get $30,000 in the business world. And I know it sounds crazy. And that's the problem with doing what I do. When I tell people what's really possible, getting 10, 20, 30, $50,000 limit accounts, you immediately should be skeptical. I would be skeptical. But if you think about it logically, doesn't it make sense? A business has a much greater appetite for revolving credit than an actual consumer does. I don't know how much, but I feel pretty comfortable to say that we spend over $100,000 a month on credit cards for the business. Now we pay them off every month. We don't have debt. We lean and mean. But we spend over 100 grand a month on revolving credit. We're nowhere like that individually. Like on the personal level, I'm not even a fraction of that. And we still pay all of our expenses on credit cards to get points and pay them all off and believe in the no debt the no debt philosophy of keeping that revolving credit carrying over. But the reason I tell you this is because, again, the limits are substantially higher on business credit accounts because you as a business need to spend a lot more money than you do as a consumer. And these credit issuers want you to do that. Think about it. They need to get 10 consumers to spend as much as one business owner. So you tell me what's more valuable to them, the one business owner with a $30,000 card or the 10 consumers with a $3,000 card? The person that spends the most is always worth more value. And that's why they give the limits so high. They want businesses to have these high limits so it's easier for you to spend money and do business with them as a result. So it's very common to get credit cards with $10,000 or higher within about 2 to 3 months. And it's impossible to accomplish the same with consumer credit. What determines how high your limits are is how high your other limits you already have are when you're building business credit, the limits on the other business credit accounts. But here's what's most important that most people don't know. It's what you're using that they look at. See, if you look at your business credit reports, and again, on Facebook Live, and you can go to facebook.com/credit suite, go to Messenger, type in EIN into Messenger, and we'll invite you to our live streams every Wednesday at 4. We look at this exact same thing. We look at how high these limits are, and we look at real approvals and what people are getting, and we look at the reports. The reports don't show your limit. They show the recent amount of credit you've used. So if you want to get high limits, you got to get credit with credit issuers you're actually going to use and use that credit to grow the business. In doing so, they see you're using it and they issue you subsequent future higher approvals. So business credit, again, as we talked about, it's very fast to build. It can be built how fast? You can get vendor credit immediately. And tonight we're going to talk about that at 5 o'clock Eastern. If you're not already registered, email info@creditsuite.com and email info@creditsuite.com, and we'll give you a link to the webinar tonight. So on the webinar tonight, we're going to talk about is how to get these vendors, who these vendors are, how to actually get the vendors to help grow your business credit. Okay, that credit reports to the credit reporting agencies typically in 30 days. Some sources like Quill report 90 days. And tonight we'll talk about a bunch of the sources, how long that takes them all to report. So typically within a month, these accounts you've gotten and paid are starting to hit your credit report. They're starting to report. Okay, that's the trigger. That will trigger Experian and Equifax scores and a PAYDEX score. So that triggers the population of credit scores. Equifax, Experian, you need 1 account reporting. D&B with PAYDEX, you need 3 accounts reporting to be able to get that. Now, once reported, then you have what's called trade lines. You have account or payment experiences. You have accounts that are now reporting on your business credit reports. That gives you an established business credit profile. That gives you the established business credit score. And then once you have that, you start getting the revolving credit, the Amazon, the Dell. So depending on how many vendors you're applying for, you can start to get to revolving credit within about 30 days because that's when stuff starts to report. I always say 60 to 90 days because depending on how many vendors you're applying for, it maybe take 1, 2, or 3 months for this accounts to report. But once they start to report, you immediately start to get the real revolving user credit. And within one more, once those start to report 30 to 60 days after, you get to the end. Auto vehicle financing, Visa cards, MasterCards, American Express cards in about 6 months' time. Now, in all fairness and in full disclosure, this is if you have some kind of idea of what's going on. Okay, I'm not here to try to pitch you to work with us because there's some of you that will want to in the faster course and some that won't. But if you're working with us where we've helped 15,000 people and we're saying apply for these accounts next, these accounts after that, these accounts after that, this is done very quickly in a 4 to 6 month process because you know the accounts to apply for in the right order to apply for them with. But the problem is that if you don't know the right order of accounts to apply for, it's going to take you longer because you're going to have to apply and get denied and then apply somewhere else and get denied and apply somewhere else and get approved and then go back to those denials at some point and reapply. There's a process of trial and error to figure this out. But if you know the system of here's the credit sources that will approve you if you have 3 accounts on your credit report, here's the one with 5, here's the one with 8, then it becomes very easy to get this done in about 4 to 6 months' time. And again, we'll be talking about that on our webinar tonight as well. And I don't mean to keep pushing that, but the webinar tonight, I have 90 minutes. So in a 90-minute time, I have a lot more time in my evening webinars to go over a lot more content than I sometimes do in our 60-minute webinars. Okay, so then you're to the final goal. Visa card, MasterCard, Amex. That happens about 120 to 180 days in. Again, everyone asks me, how long does it take to build business credit? There's 2 factors. 1, how much credit are you applying for? And 2, how quickly are you applying for the credit? You show me somebody that gets 7 vendors and somebody else that gets 2 vendors. I'm going to show you how the guy that gets 7 can build business credit a lot quicker than the one that got 2 because they got 7. So they have a better chance of some of those 7 reporting faster than the one that got 2 and that's waiting for both of those 2 to report. How many accounts you apply for is going to give you a better chance with more accounts of more of those accounts reporting faster, which expedites the business credit building process. And what accounts are you actually using? You can't just get this credit. The credit issuers need to see that you're using it to get the higher limits. So you determine the pace of how long it takes you to get business credit, depending on how many accounts you're applying for and how long it's taking you to apply. The only restrictions for the process itself is that you need to give about 30 to 90 days for those accounts to report. So again, I've told you some report quarterly, every 90 days. Like if you're a client, you know that. We tell you the ones that report quarterly. Some report monthly. If you're not a client, if you don't know that, then you want to get as many accounts in each cycle as you can to have the best chance of them reporting within 30 days to expedite the process. Then you'd only need 30 days for the vendors report, 30 days for the revolving accounts to report, and you're golden. But notice nobody's ever heard me ever say you could build business credit in 60 to 90 days, which really is possible because I like to set reasonable expectations. Expect 4 to 6 months. But in 4 to 6 months, if you know the order to apply and you're applying, the credit's reporting, and that gives you enough time to get to the final tier of auto vehicle financing and cash credit. So startups can build business credit as well. As a matter of fact, it's perfect for startups because most banks want to see that you have 3 years of financials to help you unless you're going into a very high cost merchant cash advance or revenue lending or revenue cash advance. And that's the ones where you're paying 30, 40, 50, 60% interest on the money that you're borrowing. If you don't want to do that, well, then you're going to go with the regular conventional loan, which won't work for startups. And even that loan I just described, you'd have to be in business a year or more. The most popular cash flow type of financing, as I mentioned, takes 1 year in business and revenue. And most consumer credit card approvals are based on personal income. But with business credit, even a startup can get loads of new credit without any of these items because you can get it with no financials. Okay. So you don't have to supply tax returns, which is good because you write off all your expenses. You leave a smaller profit. And most lenders and investors don't like that. So business credit doesn't look at financials or bank statements. So even if you don't have cash flow, even if you don't have high limit revolving credit accounts, it doesn't matter. Tax returns aren't looked at either. So even if the business shows a loss, you can still be approved. You also don't need collateral. So most business lending programs need collateral because if you fail on the loan, then they have something to take back. Okay, it's why it's so hard to get money because most conventional banks, the big banks, they're not even going to help you unless you have some kind of collateral to offset their risk. Okay, so in a lot of cases, they're not even going to accept any kind of or give you any kind of financing without collateral. But business credit's one of the only ways to get the money that you need without the actual collateral. So I call this the 3 C's of lending. It's extremely important to you if you have an interest in getting money for your business. Hear exactly what I'm saying because you won't see this published out on this internet thing. Okay, it's 3 C's: cash flow, credit, collateral. All lenders are looking at one of those 3 things. Okay, so when you go to look at a loan and go, will this work for my business? Keep in mind that I've said this. What are they looking for? They're either looking for your collateral, they're looking for your cash flow, or they're looking for good credit. So seed capital, they look at good credit. They issue you credit lines based on good credit. On deck, they issue you money strictly based on cash flow or revenue. Okay, any other lender out there that deals with asset lending like equipment, well, they care mostly about the collateral. They all care about one of the 3 C's. And even though they won't tell you that on their website, and when you're applying for the program, if you look at the questions they're asking, you could typically see which one of the 3's they're digging into. Business credit is the only kind of financing that exists in the United States that you can get for a business when you don't have any of the 3 C's. So if you're a startup, you don't have cash flow. You probably don't have collateral either. Maybe you have stocks, 401ks. Most don't. Okay, that are in that stage. And maybe, and you probably, maybe you have credit issues, maybe you don't. But if you have credit issues, you don't have cash flow yet, you don't have collateral, you're unlendable in every other world. But in the business credit world, you can still come in and get hundreds of thousands of dollars. We had a client on last month that got over $816,000 in business credit with bad credit, even when she was getting her both businesses off the ground. Because it doesn't look at cash flow. It doesn't look at credit. It doesn't look at collateral. It doesn't look at the 3 C's that are necessary to get a loan. Now, the way the 3 C's formula works, the more C's you have, the better the loan you get. So when you have good credit and cash flow, 2 C's, you start to get to term loans. You start to get to lines of credit. When you have all 3 C's, cash flow, credit, and collateral, you get SBA loans. That's the graduation process of going from one loan type to another. But business credit can be obtained as a startup, even when you don't have any of the 3 C's, the only kind of money that's available without one of the 3 C's. So knowledge of business credit provides a huge competitive advantage because 90% of the general population knows nothing about it. So now that you do, you have a competitive advantage because look, it's easier to grow a business with access to money and because you could do things like test advertising and not make mistakes that can cost you everything. Okay. When you have access to capital, you just have a big advantage over competitors who don't. Okay. And think about anybody that's one of the biggest publicly owned companies out there. They have huge advantages because they have these massive injections of cash flow or of cash that then helps them grow the business. So you show me a business owner with access to 100,000 and a business owner that has access to 3,000, and I'll show you a business that can grow 10 to 100 times faster because they have the capital to invest in the growth of the business. So having access to money gives you a huge competitive advantage, especially over those that don't know about business credit and don't have that kind of access. Business credit's also the best way to get the capital to fuel a business. The truth is most businesses do fail. And again, according to SBA, as I mentioned before, lack of access to capital and management mistakes are the 2 reasons most businesses fail. When you have more money, you can afford to make more mistakes. This is great news for me. Okay, we know most businesses fail. You know it, I know it. We hear it all the time. Why? Well, here it is. Lack of access to capital makes sense. Things go wrong. The business doesn't have enough cash on hand to carry them through that time to be able to make things go right. Management mistakes. I don't know what I'm doing. I don't know about you running a business. I'm learning as I go. Okay. Every new day is a new experience for me in running a business. As entrepreneurs, we are learning things every day we did not know. So that means we are oftentimes making mistakes, especially in the early stages of the business. So to me, this is really good news. These are two things that are fairly easy to control. If you have access to revolving credit, you immediately fix the lack of access to capital. You have the money to carry you through when unexpected things happen. You also have the money to learn things, figure things out, and make mistakes as you're going through this process. Use Twitter as an example. Twitter could continue to lose money for 412 years without running out of cash. So they have plenty of time to figure out how to fix their woes to make them a profitable company. You and I don't have that luxury. We don't have 412 days. We don't have 412 weeks. We might not even have 412 hours to figure things out before it becomes detrimental to the business. So these are easy to control if you have access to the money you need to support the business. So having access to capital helps save you from both of the main reasons that businesses actually fail. So let's talk about business credit success in the real world. Look, every highly successful company in this country has business credit. Most of these companies use their business credit to get as big as they are today. And business credit's not only for big companies, though. Any company can build it. So let's talk about this. Why does 90% of the business population know nothing about business credit? Think about it. Because credit issuers want it that way. It works better for them. Why would they ever, in their right mind, tell you to not provide a personal guarantee if you are willing to provide a personal guarantee? If you are naive enough to do it, they are not going to stop you. It's the same reason that you don't walk into Staples or Office Depot or Target or Walmart, all of which offer corporate credit cards. You don't walk into any of them and them ever tell you upon register that you could save 20% by getting one of those cards. Here's what happens. By default, the people that know about what I'm teaching you are typically financial savvy people. I'm one of them. I've spent 17 years in financial services. I've owned a consumer credit company. I've owned a commercial credit company now. So I know a lot about this topic. The others are CFOs. They're finance controllers. They're high-level finance people. But here's the problem. When do finance controllers, when do CFOs come into a business? They don't come in the beginning stage. They might not even come into your business until your business is generating $10 to $20 million. So what happens is business credit by default is only been available to bigger companies because bigger companies by default have financial savvy people like controllers and CFOs that know enough about it to help the business get it. When a CFO or a controller comes on board, they stop letting the business owner supply the guarantee. They start teaching the business owner about business credit, and they start getting corporate credit, business credit for the business instead of relying on the business owner's personal credit. But most business owners don't even know this or think about this until they get that financial savvy in their business. And at that point, they're no longer a small business. They're now a medium-sized businesses where all the woes of startup in the first 5 years are they're well beyond. So by default, the system has completely been based on ignorance. It's based on the fact that a typical business owner is ignorant to how business credit works. And I don't mean ignorant is a bad term or an insulting term. I mean, you just don't know. You don't possess the knowledge, so you don't get it. But here's the real world case, is that any business can actually get business credit. Anyone. Any business can get it, even from a startup, the same as successful businesses do, following the same steps that successful businesses do. It's just that the bigger companies are the ones that typically have it because they're the ones that possess the personnel with the knowledge to actually get it. That is until, of course, you're tuning in today. So big companies are typically the ones who benefit because they have these financial savvy people when small business owners don't. But again, you can get your credit hands on the same credit that they have as long as you know what we're talking about here, know the steps to obtain it. So bonus. 16, establish a business credit history before it's needed. Look, you got to establish a credit history before it's really needed. Credit history is one of the components of calculating your business credit score. The longer and better your history, the better a business credit score is going to be. So when you consider what your credit score needed for a business loan, then you need every bit of the score that you can get to get the loan and to get the best terms. And if you start early, it can only help you. Look, this is a process, whether it's 3 months, whether it's 6 months, whether it takes you a year and a half or 2 years because you're trying to do it on your own and you don't know all the nuances. It takes time. It's a process. So many people come to us and they're already in desperation mode. I need money. I need it now. Well, that's the problem. Nobody wants to lend you money when you need it now. There's this perception out there that lenders don't want to give you money when you really need it. And it's true. They don't want to give you money, not when you really need it. Replace that with when you're desperate. Nobody does. You ever lent money to a desperate friend? If you got it back, good for you. Never had that happen before, okay? Because when people are desperate and they're going for the last people that'll give them money, those are the last people that usually get paid back. Usually it's too late. This is why you can't max out your consumer credit cards, because that's why lenders and credit issuers won't lend you money. They see you're maxed out. They see you're overextended with your revolving limits. They will not touch you. This is why you got to do it before you get overextended. Then you won't even get overextended. Okay. The other thing is you need to make sure that you do this and start this process before you need it, because you're going to need access to these credit cards. You're going to need access to loans. You're going to need access to credit lines. I don't care who you are. If you're building a business to grow, not a lifestyle business. I have friends that are in lifestyle businesses. They earn enough to live the life they want to live, and they spend a bunch of time with their family. They may never want to grow the business, so it doesn't matter. But anybody that wants to grow the business, you're going to need access to capital to do so. You want to get this started before you need it, because it is a process. You also want to make sure that you have it for those unprofitable times. Prepare for lean times, okay? Don't be naive. Don't be naive and think you're never going to slow down. You're never going to have an off month. You're never going to have a marketing campaign that doesn't work. That's insane. You will have those things. You have to prepare for lean times. If you're a seasonal business, well, that's just part of the DNA. You know you're slow sometimes, but every business goes through those leaner times. So if you have to make payroll or equipment payouts or cover rent, then you need some money to carry you through when you get by. And business credit can definitely give you those things. By establishing business credit before you actually need it, you're far more likely for you to get the terms that you actually want to get, okay, when you're doing this. So it makes it more likely for you to get the money you need when you need it. Now, trade credit can really help you. You should use it. Work directly to establish relationships with these trade vendors. And we'll talk about this on our tonight's webinar. Again, if you don't know about tonight's webinar, two things to do. Go to, well, actually just email us, info@creditsuite.com, and we will get you the invitation. So these starter vendors we're going to introduce you to report to one of the reporting agencies. So they get you access to money you need to remove or to help ease cash flow constraints. And at exactly the same time, you're building business credit at the same time. And again, tonight at 5 o'clock Eastern, we're doing a 90-minute presentation on 7 types of vendors you can get to build business credit. So if you're seeing this live as we are sitting here on October 9th, 2018, make sure you email info@creditsuite.com and we'll get you an invitation, or we'll give you an invitation to playback if it's after that. And again, as we talked about, business credit can help you get the loans. It helps you meet the requirements that you need to be able to get the best terms on loans. And your business credit history matters, okay? Because it affects your business credit score, which more profoundly affects your ability to get money than anything else. So pay your bills on time, pay your bills in full if you can, and you're going to have good business credit. Even if you can't, at least pay them on time or early. Establishing business credit early means you'll have access to that money and more time and opportunities to do things as those opportunities come up. So let's recap. There are a lot of reasons to build business credit. It's independent of personal credit. It doesn't affect your utilization rate. Okay, it can be built quickly. Since anyone can see your business credit reports, it bolsters your reputation with suppliers, customers, even competitors. And don't forget on the credit part, it also doesn't affect your utilization. Business credit protects your personal assets, doesn't require personal guarantees either. Business credit increases the value of your business. It determines if you'll get approved for loans, the rates and terms you'll pay, the amount of money you'll get. It effectively doubles your borrowing ability because it gives you consumer and commercial credit, and it more than doubles your borrowing ability because per SBA limits on these accounts are 10 to 100 times higher than you're going to find with consumer credit. Even startups can get it. Even those with no collateral, no cash flow, no credit, not lendable can still get it. It's a huge competitive advantage, and it's the best way to fund a business as well. And even big established companies have it. Why shouldn't you? As a matter of fact, companies like Walmart, 80% of what they actually buy, they use business credit to buy. Again, it's how they've got as big as they are. build business credit before you really need it. It's only going to help you if you do so. So that's 15 reasons. That's more than 15. As you can see, I'm pretty bad at counting. I always under promise and over deliver. So there's about 20 plus there that we really dove into. And if you have any other questions, well, make sure you grab our free guide, creditsuite.com/EIN. That maps out the steps of building commercial credit. Like and subscribe to our channel. I like that because you get notified. We go live every single week on YouTube, and the only way you're notified is if you follow us on YouTube. And get in touch with us. If you have any questions, if you want to expedite your business credit building, if you want to take years of this process into months, then feel free to give us a call, 877-600-2487, or email us, info@creditsuite.com. And if you email us there, we will also send you an invitation to tonight's webinar. Even if you're seeing this past the 9th of October, we will then make sure that you also can get a playback to that webinar. So if you have any other questions, reach out to us and let us know. Thank you all very much for taking the time to tune in. Hopefully I'll see some of you this evening as we'll dive in to 7 different types of vendors that can help you build business credit. And I look forward to seeing you on our next YouTube Live next Tuesday at 1 o'clock Eastern. Thanks, everybody. Have a great day.